Crypto looks more like a currency in terms of its correlation, which is known as Bayesian in distribution, which means it has passing correlations that shift always.
Over the past few weeks, the crypto market has seen a lot of volatility. Bitcoin, especially, has been on a wild roller coaster ride with bulls trading hard to break key resistance levels. However, one important factor will continue to affect the whole investment space, and that is inflation. From hedge funds to marginal investors, every type of investor in the space has to reconsider putting in more funds when there is still so much uncertainty surrounding the effects of inflation on Bitcoin. In a recent interview, Real Vision CEO Raoul Pal shares his thoughts on current market conditions and the reason for the increased volatility. Welcome to Savvy Finance. In this video, we examine Raoul Pal's thoughts on the current market situation and some of the crucial things all investors must consider in such situations. Please watch the video to the end and hit the like button. Enjoy the video. Raoul Pal is the CEO and co-founder of Real Vision and no stranger to the crypto community. The former hedge fund manager and investment strategist always has important details to share about the market. In this interview, Raoul Pal talks about his Bitcoin hypothesis, which is founded on Bitcoin being a perfect collateral layer for the new digital economy. Raoul Pal explains that Bitcoin's scarcity solves the problem created by existing layers of the economy, making it a perfect way to avoid the debasement of money. Not only does it serve as a perfect foundation of a new, digitized, and decentralized system of investment, it is also a better option compared to many other asset classes.
So my view on Bitcoin kind of remains what it always was, which was coined this a while ago, is I think of it as the kind of perfect collateral layer of this new digital economy, because it's pristine collateral in the way that it can't be debased. You know, if you think of how, let's say, a treasury bond works, it's kind of weird because when everybody needs treasury bonds, the Fed creates more of them. So your collateral is actually worth less over time, which is the debasement of money idea. Now, you can't do that with Bitcoin. So if Bitcoin is your base layer of collateral, then what you get is an ability to get paid for people wanting collateral in a collateral squeeze, which is what the financial system needs at its base. But it became obvious to me, Bitcoin doesn't solve every problem. It solves certain problems really well, and others it doesn't solve as well. That was really my evolution. And then as the space broadened out, you realized, okay, this is an incredibly deep, fast-moving space with so many applications that it doesn't make sense to be all on one blockchain. Different blockchains will specialize in different things. So that's basically my Bitcoin hypothesis.
Raoul Pal also weighs in on the increasingly volatile market conditions. He explains that the market does not respond well to a shift in narratives. This is why it has become more volatile and erratic as inflation increases. But the narrative is shifting again as both growth and inflation are slowing down faster than anyone expects, yet again sending everything into disarray. From here on, Raoul Pal believes the Federal Reserve will have to make carefully considered reconciliatory efforts to avoid having to resort to more stimulative measures.
Would love to get like what you're seeing in the markets now, as an asset allocator.
The macro environment is, I think, why we're seeing volatility right now is the shift of narratives. Markets don't like that shift. So the narrative was the inflation shift. Inflation shift last year, I think what happened is inflation was real and inflation destroyed marginal spending and marginal investing. And I think we've seen it in meme stocks. We've seen it across the market. We've seen it in cryptocurrencies where the marginal investor got marginalized because they didn't have enough money. So I think that was one of the features of what happened. And the bond market was pricing in some more inflation, but not a great deal. However, that narrative is shifting. All the forward-looking indicators I look at look like both growth and inflation are slow much faster than the market expects. So then they're struggling to think, how do we price growth equities? How do we price other types of equities in that shifting environment? Because we're going to have a period of time where growth is slowing and inflation is going to look high, and then inflation follows because inflation lags. So I think we're at a shift. My general view, and I've held this for a while now, is that the central banks are more likely to get away with one hike, two hikes max, before they're looking at stimulative measures again. Because I don't think the economy has got traction, and we don't know what the true traction is of the economy until maybe 2 years, 3 years after the pandemic recession has followed through. That's very typical of every recession I've ever followed, is basically there is a growth slowdown that comes fast afterwards. The market panics, starts talking about recession again. Usually that doesn't happen. There's generally more stimulus. So I think it's very supportive of crypto prices overall. I think crypto's gone through that transition phase. We saw the marginal spending, investing in crypto go down. I think now all I'm doing is speaking to large institutions about investing. So I think the ongoing investment thesis continues. And I think that the central banks will be more dovish than people expect going forwards. So we should have a longer cycle with more tailwinds than most people expect right now.
Today's video was sponsored by Delta. They say information is power. In today's world of extensive investment opportunities and possibilities, you should take advantage of every tool that can help you get the best of your investments. Delta is a tool that helps people make good financial decisions by providing them with a crystal clear overview of their assets and all the necessary tools to analyze their wealth. The beautiful and easy to navigate design allows users to classify their assets based on their level of importance and follow market-specific news without missing a thing. To get started, download the Delta app, follow the prompt, and input your investment assets and exchange connections. Delta provides users with detailed price movements through hourly push notifications all day long. With Delta Pro's detailed analytics, you also get in-depth analysis of your assets and market trends. What's more, you can use Delta for all types of investment assets, including cryptocurrencies. Click the link in the description box to start making better financial decisions with Delta. Lastly, Raoul Pal talks about the correlation between cryptocurrency and other assets, especially stocks. Though the crypto market is separate and independent, there is still some correlation between the two and other asset categories. As Raoul Pal points out, everything interconnects and decouples in intervals. A good example of the first case is the aftermath of the Fed's January announcement that they were raising rates and reducing liquidity. The announcement profoundly affected the stock market. Investors were subsequently subdued and prices took a nosedive. Raoul Pal adds that decoupling usually occurs in certain enabling environments, such as when growth is okay and central bank policies are loose.
Awesome. And just last question, do you think the correlations relative to other asset classes, how do you see that playing out? I know we've seen the last few months quite high correlations with just tech equity. Would be curious to get your thoughts there on how that might evolve.
So look, everything is a risk curve. Every single part of the investable universe, and crypto is part of that risk curve. Sometimes it's correlated, sometimes it's not. When you go to a macro shift, everything gets a correlation of 1.
Right.
And we've seen that. So it periodically correlates and periodically decouples, depending where we are on the risk curve. It tends to be really decoupled in that mid-cycle phase where growth is okay, central bank policy is loose, crypto does its own thing. But it's when people are having to bring cash back, let's say you're a hedge fund, you've now got a mandate to invest in crypto, you've got your equity position blowing up, you need to reduce risk, the risk manager taps, as volatility rises, VAR means you reduce your portfolio risk, so you're selling crypto, even though you don't want to. It's a function of risk markets. We won't get around that ever because everything is the same unless it's got no mark to market, which is why people like VC and people like real estate, because there's no real-time mark to market. But I think the correlation, crypto looks more like a currency in terms of its correlation, which is known as Bayesian in distribution, which means it has passing correlations that shift always. And crypto does that because it's correlated to the bond market, it's correlated to the equity market, it's correlated to something else. And it comes and goes, and sometimes zero correlation. And that's very typical of currencies. People think currencies are interest rate differentials and stuff like that. Virtually no correlation to that at all.
Bitcoin and other cryptocurrencies are still relatively new asset categories. Many of the assets with huge market capitalizations today started with some mishaps before they developed and matured. In fact, considering what Bitcoin has been able to achieve in such a short time, all other asset categories pale in comparison. Decoupling from other asset categories will become easier as the market matures more, and we would probably see less volatility. Thanks for watching the video. Remember to click the like button and share the videos with others. You can also drop your comments and observations in the comment section below.